Hey guys, what's going on? This is John from Friends with Your Benefits. Today we're here for part two of our video on stop loss, and joining us today we have Mehb Khoja from BCS Financial Corporation to talk about what you can expect from your 2024 stop loss renewal. Hey Mehb, how's it going? Welcome
Hey,
back to the
John.
show.
Thanks for having me back. I guess the first one went pretty well, so you invited me back for number two.
Definitely. So it officially is stop loss season now, and many clients out there are kind of going through their stop loss renewals. Some are going through RFPs. And I got to ask you, there's that old assumption out there that, hey, if you have a decent loss ratio, that the stop loss renewal should be anywhere between 15 and 25% per year. Is that still reasonable?
As the stop loss carrier, that's what we're shooting for because there's leverage trend and the cost of services go up every single year. And when groups keep the deductible where it is, we typically see that stop loss trends can be roughly double what underlying inflation is. But in all honesty, it's a pretty crazy market right now. This is what we call a soft market, meaning there's a lot of capacity out there. There's a lot of new carriers that are in the space, very eager to write business. And so that typically puts pressure on carriers like us to be able to achieve that leverage trend. So hopefully that answers the question, but we would like to see a leverage trend type of increase on our renewal. And certainly that can vary based on the actual experience of the group. Groups that are running worse than expected or have some type of ongoing claim that'll come into the next policy year, they'll probably see generally a higher increase to that. Groups that have been running really well and no claims or very low claims, those are the ones that carriers tend to get aggressive on at the time of renewal.
So I want to go back to your earlier comment about the overall soft stop loss market, right? And I've certainly seen examples of it where one carrier out there in force, they may say, hey, to a client, you're getting a 40% increase. But then let's say a newer player out there might actually give a rate pass. Yeah, if you're a client, like, do you take a look at that and say, like, hey, it's kind of a great renewal, or is there anything really that they should look out for before they just take it and run?
From my perspective, like we want to have partnerships with clients and producers that is a long-term partnership that has both sides giving in at times, but in the long haul, having like a long-term partnership. And in this space where you see the emergence of some extremely high dollar claims, I don't think it's a good idea to be changing carriers very frequently, and certainly there's savings to be had. It's kind of hard for some groups not to look at the savings because
Sure.
they feel like stop loss, if it's a commodity decision to them and there's a carrier that's willing to do it for less, then why wouldn't you go to that other carrier? But I've seen this time and time again where groups run great for some time and then they have a sticky situation that may require like an ad hoc or extra contractual payment. And stuff like that is typically easier to do when you have a long term relationship with the producer and with the client. It's not so easy to do when it's a group that gets commoditized every single year.
Understood. So recently I saw you had something posted on LinkedIn, right? And you're talking about some of these very large high cost claims, as you alluded to before. What are
hmm
some of these very large high cost claims that you've seen before? Is it mostly hospitalization, cancer spend, or is it some of these gene therapy medications? Walk me through that.
Yeah, it's all of the above, but in terms of like the highest cost spend, it is gene therapy. These are treatments that are one and done type of treatments, and that treatment can extend life. In some cases, it can like cure life, but they come at an extremely high cost, anywhere between $2 to $4 million. Some of the conditions that are getting served by gene therapies today: spinal muscular atrophy, Duchenne's muscular dystrophy, hemophilia, sickle cell. That's a treatment that's in the pipeline right now. And these, again, the costs on these can be anywhere between $2 to $4 million. And so when a claim like that happens, or when there's a claimant that has the condition that could be serviced by that gene therapy, most stop loss carriers are going to look to run from that
Yes.
placement. So we see that as like a big problem. And lasering is, it's like a four-letter word in the stop loss industry. So we're working hard to develop solutions that include pooling over large swaths of lives that can help subsidize that expense at a lower price point, and so that employers don't have to worry about the potential for lasering.
So I've heard a few different strategies out there as it relates to these various super expensive medications, right? And I view it as almost winning the lottery in reverse, right? You get
Yeah,
stuck with a
the unlucky
massive bill of
lotto.
goods. Yeah, 100% right there. So, some solutions that I've heard, and I'm curious your perspective. So, number one, so some clients say, okay, now's the time to do reference based pricing to protect against this. Some
Mhm.
have said, and this might be outside, this conversation, maybe 403B pricing, could be something to pursue. And I've seen, some of the carriers out there say, hey, we have this capitated product where we basically spread the risk across our entire book in return for the clients paying per employee per month or per member per month cost. So, let's walk through those. Have you seen any of those actually exist in the marketplace? And if so, do you think any of them could have legs in the future?
Yeah, so when you're thinking about reference based pricing, that is not a solution that's going to work for gene therapy. So gene therapy is a hospitalization expense. It's a medical expense that's predominantly driven by the ingredient cost of the gene therapy. So a Zolgensma, which is the gene therapy for spinal muscular atrophy, costs about $2.2 million for the ingredient, and the hospitalization on that is $5,000. The reference based pricing solutions typically target the hospitals for overcharging on services relative to Medicare. And so, because this is the wholesale acquisition cost of the drug, reference based pricing is not really going to work as a solution for gene therapy. 403B pricing is for hospitals that service underserved populations, and it could be that you have employers that have members that use that hospital as well. But because the employer that contracting is done on the commercial side, they're typically not eligible for that 403B pricing. Now, we have seen 403B pricing come into play for things like factor medication and specifically to hemophilia. I
Mhm.
have not seen it come into play for gene therapy. And again, gene therapy is really new. It could be that those programs, reference based pricing included, may have some future utility there, but we haven't seen it yet. Capitated programs. So this is where I kind of see a lot of legs. There's some competitors that have developed like a like a performance guarantee type of solution, and then there's carriers, and we're one of them that has developed a filed product. So we see like an opportunity to have a standalone gene therapy stop loss product that is filed in the state. There's a lot of benefits to a filed product. There's a lot of consumer rights to a filed product, whereas like a performance guarantee, you don't get the same benefits. Performance guarantee is like a contractual agreement, as opposed to a filed product is something that we have to take to the state, have the state approve it before we can actually distribute the product. So I think there's pros and cons to both approaches. We've chosen to have a filed product and lead with that so that the consumer is fully protected.
So one thing with this capitated product, right? And there's certainly when I look at the book carriers, it seems like all of them are starting to come out with their own version of a capitated program, at least what I've seen in the marketplace. And I think if let's say you're a client who doesn't have stop loss, it definitely seems like a great way to protect against risk. For
Yep.
clients who do have stop loss, as of right now, I candidly haven't seen the stop loss carriers provide a discount or require that that program is in place in order to write coverage. Do you see that changing in the future?
Um, Hard to think that that's going to change because right now gene therapies are like a 1 in 5, 1 in 10, 1 in 15 year event. And
Mhm.
so it's really hard for a stop loss carrier because, again, healthcare is a 1 year deal. And so it's really hard for a stop loss carrier to make that adjustment. And even if they did, it would be a really small adjustment. If we're talking maybe in a couple of years from now, when there's 20 to 30, maybe even 40 gene therapies, it could be a different solution at that point, or a different answer. I mean, today we have 7 therapies that are FDA approved. In 22, we had five, so two just got approved this summer.
Mhm.
And there's two sickle cell therapies that are expected to be approved later this year. So then we'll be up to nine. I would still say, critical mass is probably somewhere between 20 to 30 before we start seeing stop loss carriers passing along an adjustment in their pricing if the group is purchasing that standalone product or the capitated product, like you mentioned.
Fair enough. So I'm going to ask you a little bit of a leading question here, right? So you mentioned before these treatments that cost millions and millions of dollars, and I think capitation is certainly one thing that can be employed
Mhm.
to perhaps mitigate the risk. But at the end of the day, healthcare is still going up. Do you feel that there needs to be some sort of additional healthcare reform to kind of put a ceiling on some of these prices, or on the flip side, do we not need a ceiling? Because if we have a ceiling, then maybe we don't have the cure for these debilitating diseases out there. What's your perspective?
Yeah, I mean, unfortunately, the topic of inflation is all over the news right now, and it's not just in healthcare. It's in gas prices, it's in grocery prices, it's in real estate, it's in interest rates. It's literally everywhere. And I saw a graphic yesterday that showed that healthcare inflation correlates to general inflation. It just lags it
Hmm.
by 6 to 12 months. And so that's kind of a scary situation, right?
Right. Yeah.
Because we know general inflation has been sky high for the past 12 to 18 months. And so the reason why I bring that up is because inflation impacts all parts of the economy, and we don't necessarily see the government get involved in those other areas either. So I don't necessarily see the government getting involved in capping healthcare inflation or even some of these super high cost charges. I could see it happening several years down the road because it's not uncommon to see a private and a public type of response to some high cost claims, like we see that in ESRD, for example. But it's not being talked about right now. I can't see it being talked about for at least a handful of years. Maybe in like 5 to 10 years, it could be something, but not right now.
Okay. So going back to the topic of stop loss, right? If you're a client out there and you get your stop loss renewal and the broker provides it to them, they're looking at it. Let's say hypothetically it's 15%. How do you know if it's fair, right? And let's say you're in the assumption you're not necessarily shopping your stop loss every year, but you want to know, want to have a good gut check. Is this a fair renewal? What would you do?
Well, typically employers are working with brokers, and brokers will market the stop loss coverage like every 2 to 3 years. It's hopefully it's not something that's marketed every year, because that's then hard to develop a long term relationship. But if I think it's completely fair to market the coverage every 2 to 3 years and hold the current incumbent accountable if the market is producing a better rate, and it's a carrier that's equally rated as the incumbent and is providing the same type of coverage, and it's just at a lower cost. It's kind of hard for employers not to take that opportunity, right? So I would say work with your broker and look to have them do a marketing on your behalf and see if there's other opportunities that are out there. Another thing here too is we're seeing a lot of bundling of stop loss as of late. So, there's a lot of group benefit carriers that either provide life and disability, and now they're providing stop loss as well. There's property casualty carriers that also now provide stop loss coverage, and then obviously the health plan, who's providing administrative services and providing cost containment services. They're also offering stop loss coverage. So I would just say try to mix some of these coverages together and get the benefit of your premium dollar scaling together, as opposed to having everything sit in a separate silo.
Absolutely. And I think, voluntary benefits is one that I've seen as of recently where the VB carrier will provide some sort of discount if they also do stop loss on the stop loss renewal if they happen to be awarded the voluntary benefits business.
Yeah, I'll take it a step further and say for us, it's not just about a discount, but it's about actually integrating the products together. So you take a product like critical illness, which covers cancer. Well,
Hmm.
cancer typically is a stop loss claim, and it's also a critical illness claim to a member who has that coverage. And trying to link those products together where we can see in the data that that claim happened, we can reimburse the employer for their stop loss claim and reimburse the member for their, the standalone critical illness policy. So we think that there's like a lot of utility in looking at those products together.
Well, definitely appreciate the perspective, Mabe. So let's say there's someone out there and perhaps they want to connect with you about their stop loss renewal or hear a little bit more about what's going on in the market. Where can they go?
Yeah, so obviously, most employers are looking to their broker for help on stop loss coverage. And so we work with Mercer, we work with a lot of other brokers as well. And so typically, I would say go to your broker. But if you're looking for some more information about our products and our solutions, certainly feel free to reach out to me, available over LinkedIn, and be happy to work with the clients directly if that's what they choose to do. But yeah, we're very active on LinkedIn. We do a lot of marketing through that platform, and happy to reach out to anybody.
Awesome. And I think you have a podcast series, right?
I do have a podcast series. It's on hiatus right now, but we'll be back in January, and we're going to start production again at that time.
Sounds good. Well, for audience out there, we want to hear from you guys. What do you need to know about your stop loss renewal in order to make a decision for 1/1/24? Comment below. Mabe, thank you so much for joining us on the show today. Really appreciate it.
You got it. Thanks for having me, John.
Of course, take care.